Okay, so let's continue our discussion on pricing and pricing strategy. Here are our five pricing strategies, we can say. The first is economy, which is basically a moderate, low-priced strategy. Now, I hesitate always when I talk about pricing strategy because some people then start confusing it with Porter's generic strategy of low-cost provider. Please don't do that. We're talking about pricing strategy. We're not talking about the lowest cost provider. Okay, so an economy strategy is one in which you have a moderate, low-priced offering. Now, keep in mind, I'm going to tell you some secrets here. Okay, what most companies do is they try to put together a product and they try to lower the price. And what they do is they squeeze their margins down to nothing. So they're making very little money on their economy products. That is not the best way to do it. What we do and what I'm advising you to do is look at your value proposition, look at your bundle of benefits, both tangible and intangible, and remove items from your value proposition. If you remove items from your value proposition and have a correspondingly lower price, you can still maintain your margins and sell your product for a lower price. Now, that is $1 billion tip I just gave you. I hope that you have gotten it. Okay, penetration. Penetration strategy is a strategy, usually it's a short-term strategy where we price our products super low so we can get in there and try to make some headway and try to gain some market share in a fast and rapid sort of way. Skimming. Skimming is a strategy where it's a short-term strategy where we know that we're not going to be able to maintain the price, and so we try to price it very high, but we also try to meet the benefits of a small group of consumers. These are consumers that are our really big fans, actually, the ones that are waiting for our product offering. For example, Apple uses a skimming strategy. They know that they're going to have people lined up. They know they're going to have people waiting for the product. They also know that they're ultimately going to lower the price. But in the meantime, they can earn super high margins from the first purchases. Or these days in movies. I mean, remember how a movie used to come out in a limited number of theaters and then roll out over time and then roll out in Europe over a couple of months? Well, now, I mean, most major pictures come out in Europe first, come out in the U.S. a couple of days later, and they come out in 1,000 theaters, 2,000 theaters all at once. Why? Well, because of people becoming bored very quickly, also because of piracy and all of those sorts of things. They know they need to have a really big weekend, so they try to push all of their revenue up front. They try to get everything up front. Also, there's a word of mouth they know that will build, and so they try to do it all up front. If they can go into the second weekend with this was the biggest film of last week, they know that they'll be able to ride that for a while because people will say, wow, a lot of people want to see it, maybe it might be pretty good. So again, they're trying to skim the cream off the top in a really quick and fast way. A premium strategy. A premium strategy is one in which not that you just have a high price, but you have a corresponding value proposition. Luxury, exclusive, elitism. It's a different sort of strategy. It's kind of an opposite strategy to the economy strategy. A holding strategy. This is a strategy where it's not an entry strategy per se. It's a strategy if we're already in the market, we try to just maintain. We don't necessarily want to gain market share, but we don't want to lose market share. We don't want to increase our margins, but we don't want to lose any money either. So these are kind of five basic pricing strategies. If we look at this little matrix here with price on the left, the quality on the top, we have this penetration strategy with the Halebop. If you've been in Sweden for any long period of time, you will see these commercials. Some of them silly, some of them stupid, some of them creative. They're just trying to scoop up as many customers as possible and then move them up to higher and more profitable services as they go along. ICA brand, okay, economy strategy, okay. Skimming, as we said down here, new film, a new album, and then premium, SAS first class. I actually need to remove that. SAS barely has a first class. We need to change it to British Airways or Lufthansa or some airline that actually really has a first class strategy. Okay. But this premium is kind of interesting because people are willing to pay extra high prices, way above what we would normally think would be equitable given the value proposition. So if you play this premium market correctly, you really can expand your margins in a significant sort of way. Pricing strategy. Again, I've gone over most of these things already. High prices, good value, penetration, to gain market share, economy pricing, low frills, low price. Skimming. Talked about. Here's psychological pricing. Here's something we didn't talk about before. This 99 cent versus one euro 1 cent sort of thing. You know, it's so obvious. I mean, we know that there's very little difference between 99 and 101. However, time and time again, research shows that 99 works better. 99 works better. Product line pricing, rationale of product range when you put items together and price them. So the Mars bar, it might be 32 cents individually. You can buy a 4-pack for 99, and bite size 129. Okay, but also keep in mind the smaller the package size, usually the less you're getting for your money. Pricing variations, off-peak pricing, early booking discounts, cashback incentive for expensive items. Optional pricing. Yeah, I think BMW was famous for this initially, but other people do it as well, where you have a price for a car that is unbelievably low, but it barely has an engine. It's basically a seat on an engine. And as you add the things that you think you need, you end up paying more than you would have paid if it was just a normally equipped car. Captive product pricing. Now, this captive product pricing oftentimes interfaces with the Gillette business model, if you remember that, where you have products that are complementary. In the razor blade, you have, again, the razor's low priced and the blades high priced. And if you can have the blades only fit the Gillette razors, then there is a contingency there. There's a complement there. And then we can lock people in our particular technology, and then earn our profits on the consumables, which are the blades in this case. It also works again for printers and copy machines and those sorts of things as well. Certainly a copy machine, you can't take the ink cartridge in an Epson and move it to a Brothers. That situation, of course, has created an industry around making secondhand ink cartridges as well as generic ink cartridges for all the major players. So their reluctance to be flexible with respect to pricing and respect to technology has opened up additional opportunities. Product bundle pricing. Sellers combine different products at the same price. You might buy a book and it comes with some software. It comes with a CD, DVD, those sort. When you bundle related items together for a price whereby your total volume of sales or your purchase per customer is higher, but your margin might be a little bit smaller overall. promotional pricing, again, special offers, discounts, those sorts of things. Geographic pricing, pricing different customers in different parts of the world. Now, this is a little tricky because with the ability to arbitrage and other sorts of things, and now with the ability of the internet, we can examine prices immediately and see where the price differentials are, and we can take advantage of those things. In the quote-unquote olden days, if you were pricing one item at one price, and even in the next town pricing it at a different price, no one would know. Now you can't do that with all the price comparison products. Now that has been a real good boon to consumers, able to compare prices over the entire industry offering and really get good prices. It's forced producers to be more honest and straightforward, and that's a good thing. Value pricing. McDonald's was one of the first to really come out with this value pricing with the Happy Meals and the bundling, where you get your sandwich and your French fry and your drink. They were very good at that, and it started during poor economic conditions and just have continued. But other companies haven't been so successful in doing those sorts of value sort of meals. So it's a tricky game to play. So, what have we learned in these couple of lectures around market analysis and strategy? We looked at the different types of market. We talked about levels of competition. We looked at types of competitors, reasons for competitive response. We looked at marketing mix with a new P, people. And we talked about pricing strategy. Before we go, it's actually a good point. I really didn't talk about people much. We know it's about product. We know it's about place. We know it's about promotion. We know it's about product, place, promotion, and pricing. But this fifth P of people we haven't really talked about. Is the people play a role in the market mix. So that fifth people is one that you need to take a look at. And in the some of the supplementary reading material, when you look at marketing mix, see when they talk about people and how that can help our analysis as well as developing our marketing mix as we go out with our products and services. Okay, thanks very much, and I'll see you at the next lecture.